Okay, so I get asked the question all the time, John, what in the heck is going on with mortgage rates? They're up, they're down, they're all over the place. So I want to put together a quick little video here, and hopefully this is going to be super entertaining and something that like you just love. So here's mortgage interest rates right now. I think they have a lot in common with a snake that just ate something way too big. A lot in common with this guy right here, Harvey Updyke Jr. Is an Alabama fan that just could not help himself but poison some trees at Auburn because he just had too much Bama in him. He's just overwhelmed by it and had to go and poison some trees. And last but not least is the mortgage industry. So like that snake that ate too much, or like Harvey or the mortgage industry, when you get too much of a good thing, it kind of slows you down. And that's where we're at right now with the mortgage industry. And we've been seeing things, and I'll kind of show you a snapshot. This is the bond market. This is a mortgage-backed security. This is a 2.5%. We'll just call it a rate for all practical purposes right now. 30-year mortgage. It's currently trading at 100.1, so 101. But you can see here, this is going back to, let's say, the beginning of the year. Here's where this was trading at. You see it's moved up. The higher it moves up means the better or the cheaper that interest rate would be, or so higher is better here. And you can see we right now are right around 100, and that's the take us back to about February 25th, 24th, 25th is when we're at these same levels. However, interest rates today are significantly worse than where they were at on that day. And a couple of reasons here. Thing number one, you've got the CEO of Quicken Loans coming out saying 30-year fixed mortgages will not go below 3%. Believe it or not, where Quicken prices and what they do can swing the entire market independent of what the bond market does. So here is a quick little supply demand, kind of how a mortgage is priced out. Excel, let me see if I can get this thing to open. Apparently it doesn't want to play nice. There we go. So let's say you have a $100,000 mortgage. We're going to use 2.5% because that was where that coupon or that bond was trading at. Say you want to make 2% on that, so 102 is 2%. And the way mortgage companies or the way the industry works, you get paid money for servicing. Let's just say that's 3/8, so 37.5 or 0.375. That mortgage-backed security was trading at 101. So this loan right here, if nothing else, just you have the cost of the bond would pay you back 1, is making 101.37. You've got the GSEs, which are the government-sponsored entities, or kind of some people taking some money through there. So let's say you were at 101.37, subtract out 1% for just Fannie Mae, Freddie Mac, just they're taking money. That leaves it at 100.375. And in a normal market, if you were trying to make 102, you'd take 102 minus subtract this, and then you would be paying 1.625 points. But since us like Harvey Updyke or the snake, the mortgage industry right now is over capacity. So you're paying a premium. So let's say that premium right now is 0.5. So this is actually costing somebody 2.125 points to get that 2.5% interest rate. So this right here, this capacity kicker, as I'm calling it, is what's impacting what you're paying for your loan. If things get slower, you might see this go to 0. In that case, this loan would only cost 1.625 points. Or if things get really slow and a mortgage company is looking for business, they may even offer some type of incentive. Let's say rates are minus 0.5. Now that rate would only cost the consumer 1.125. So what we're seeing right now is you've got this capacity kicker is in play, and mortgage companies, because they're so busy, are charging more for rates today than they would have in the past. And that's what you'll see when you look at why, or people ask me, why are rates higher today than they were, let's say, 2 weeks ago? And the bond market is in a better spot. This is the reason right here. There's some additional profits being taken, kind of at the big boys at the institutional level. It doesn't trickle down to you and I, but you see it in your rate sheets every day. That's it. Thank you very much.